right now, we're not expecting the housing market to have a severe downturn. In fact, we jokingly say the residential market could be, or is a tall midget in an environment where you would have a softening economy. I've been really surprised by the resilience of the overall market. And I think goes back to, I think about back 30 years ago when I was building regression models and realizing that it's really about jobs and jobs and jobs and consumers' confidence in those jobs. So no matter what affordability is doing, as long as people are feeling good about their situations, the resilience has been, it reminds me back to the early days when we were doing that, as opposed to being concerned with every 10 basis point increase in rates. So the rates are secondary to confidence in jobs.
Talking about housing and the real estate markets in America with Ivy Zelman. She is a co-founder of Zelman Associates. Thank you for being here.
Thank you. Pleasure to join you.
Yes, welcome to the David Lynn Report. Let's talk first about the residential housing markets. I'm looking at the Case-Shiller Index, which is a conglomerate of the biggest cities in America. And although the index has been declining for the latter half of 2022 and into this year, it's recently picked up again. People have been wondering if the housing decline in prices has troughed. What do you think?
I think it has for now. I think that the housing market has been surprisingly resilient with respect to overall demand and pricing. I think part of that really stems from two factors in the existing home market. There is secular pressure on mobility because of the aging population. People move less often as they age. And secondly, because of the historic low rates that we had because of the pandemic, over 90% of people are locked in below 5%. So it's actually over 50% are locked in below 3.5. So it's really disincentivized people to move. So there is a significant drop in new listings, and inventory is at pretty much record lows. So there is a very limited amount of product available for sale, giving those units that are available more pricing power. And I would say that it's interesting just from the perspective that it's really preferred supply. So if you're in a good location and a community where there's amenities or any factor that is really positive in the perspective of a good school district, those homes can see multiple bids right now. Where on the other hand, if a home is on the peripheral and near traffic and undesirable location, you could see those homes sit a lot longer. So it's somewhat bifurcated, whereas anything and everything was selling. The investors have pulled back quite a bit, and that's a whole nother discussion. But I do think that the transactions, the actual units, are kind of stuck between 4 to 4.5 million right now. And I do think that the new home market is the beneficiary because of the lack of units on the existing side. People are turning to new, and therefore the new is gaining share. And one last, I know I talked too much. So one thing I would just say is that the new home market, interestingly, pre-pandemic, basically accounted for about 12% of transactions. And now post-pandemic, running through 2023's first half, we're running closer to 17%. So the new home market has gained substantial share in a fairly brief period of time in 3 years.
Do you think that inventory will remain, squeezed, especially for the new home market? I'm looking at the new residential construction housing starts. For the month of May, it was at 1.49, almost 1.5 million units nationwide. That's 5% above April, so it's a slight tick up. Do you think this is going to catch up to demand anytime soon?
Well, first, you have to break that down between single family and multi, because the multifamily market has been unbelievably resilient despite the cost of capital. It's gone up substantially. So single family really for 2023 is going to be down, we estimate about 9%. So that's single family starts. But nevertheless, we do see the builders, and 50% of the new home market are publicly traded home builders. Interestingly, their share back when I started 30 years ago was below 10%. So they're gaining share. Of course, their cost of capital is lower than privates, but they are building more spec because they see the momentum and they see demand has been more resilient despite rates going higher. So I think you'll see the second half of 2023 will probably slow, but right now through June of 23, the public builders as well as our private builders that we survey have seen very strong market dynamics. And we do think they're going to continue to start more inventory because of that, leading to a softer second half.
So generally then you would say that the new home market, like you mentioned, would be stronger in terms of sales and demand.
Oh, yeah. Well, I mean, the resale market what sells, again, you could see pretty significant multiple bid situations. Depends on, again, the unit. My former father-in-law basically put the house on the market and at ask, and it went like 20% above ask. So it depends on the home, the price point, and the location. But I would say that the new home market is outperforming the existing market from a unit perspective, but both are experiencing firmer and even accelerating price depending on the market. The Southeast is outperforming the Northeast. The West Coast is now starting to see what had been an underperformer, starting to see some relative outperformance. So the dynamics of the market are really fueled by the strength of this economy and the fact that job growth is still so strong, along with wage growth, and consumer confidence is strong. But it really is, I guess, somewhat bewildering to me because affordability is stretched about 20% above historic trend lines. And some of that really can be explained by people's perception, well, I'll just refi. So the expression is rent the rate, marry or date the rate, marry the house. And so basically refi, or there's all the presumption because we're trying to figure out how the market can be so strong other than job growth and wage inflation. There's also this great wealth transfer that people talk about. So whether it's Gen X like myself or boomers that are transferring and helping their children with down payments, their adult children, or even buying houses outright for them, that's taking some of the pressure on affordability. And lastly is the continuation of the arbitrage, moving from high cost states to low cost states. And for example, you go from New York to Ohio. I live in Ohio, and you would just have to add a zero in Ohio compared to New York. So that's enabling people to continue to, offset the affordability.
You mentioned that the majority of homeowners currently are locked in sub 5%. I wonder how much of that is fixed permanently, or are those variable rates that they're locked in so far and need to be refinanced at some point?
They're predominantly, I would say, somewhere between 90 and I don't know, 100%, because the, ARM market was so unattractive because rates, call it sub 3% mortgage rate. You had to be living under a rock if you didn't take advantage of that duration, 30-year fixed. So very little, from a mortgage origination perspective, I would say it was running probably like 6% or less on an ARM.
So
Or
you're
the
not
ARM.
concerned about a repeat of
No.
2008 when in which people had to refinance at higher rates and had to, foreclose because they couldn't afford it.
No, I do think that the area that's probably concerning from a distress perspective are investors that are not cash flowing as much as they had because they're not successfully on short-term rentals getting the same level of passive income. So their cost of capital is higher. Their overall passive income is not as strong, and their cost of managing those homes is probably higher. So there could be some forced sales. There's always, real estate, we talk about the 3Ds: death, divorce, and default. And I think investors are seeing more pressure because whatever the boom of rental short-term leases is under pressure.
How much of the mortgage payments overall right now are, I would say, to the point of becoming unaffordable if incomes drop? In other words, is the mortgage to total income ratio at overstretched levels right now, do you think?
Yeah, no, it is. That's why I was saying it's right now, affordability is 20% higher roughly, and continues to even be probably closer in the mid 20s now because of rates moving up 40, 50 basis points in the last week. So you have a tremendous pressure, or 2 weeks, on overall upward pressure on rates. So affordability is stretched above trend line between 20 and 25%, I would say, which is moving in the wrong direction. Income, of course, is yet to be under pressure in any significant way, but the affordability is historically very stretched.
Do you have any insight as to whether or not a coming recession, if you think a recession will hit, would significantly impact people's ability to finance their homes right now and pay off existing mortgages?
I think that historically, if we go back, post World War II, the housing market really has not seen national deflation in nominal terms. In real terms, we have. So when we look at recessions, they've been historically very regional in terms of whether you go back to areas that have been under pressure with respect to price, whether it be in the Northeast, in the Southwest, in the West. But nationally, we don't expect to see national deflation. For 2023, we're now looking for flat to 1%, maybe modest deflation in 24, contingent on a economic downturn, assuming the Fed doesn't orchestrate a soft landing. So you could see, call it plus or minus 1% in that range on a nominal basis.
Shortly after the pandemic, or even during the pandemic, there was an influx of people moving into the suburbs. Is that trend reversing? Are people moving back into the cities?
I think that the bifurcation has definitely been less as wide as it had been, but we haven't seen this, significant shift back to the urban markets. If you look at urban versus suburban, it's kind of been holding steady and not much change. But I would say that because people can still work remote or hybrid, a lot of changes that we've seen are those residents that might have left the state entirely. So for people that were California residents that might have gone to Phoenix or Boise, their employers like, you have to come back because you need to be here 2 days a week. That's caused initially some disruption in some of those markets where they actually saw 22 actual negative price impact. And I don't know that that was the only reason. Also, rates went up a lot, but you're seeing some changing dynamics from what we saw benefiting from the pandemic. But I wouldn't say that we're seeing a rush back to urban markets at this point. And that's a lot to do, again, with the employers allowing a hybrid work environment.
So what I was wondering is, some urban markets like San Francisco, New York, for example, they've seen a decrease overall in rents in some areas in the city. Would that trend reverse now that after the pandemic is over, do you think?
Well, I think that we're seeing rents nationally in suburban markets are decelerating too. And I think that rents just got way ahead of themselves. And that has a lot to do with the supply is the greatest. So the supply that's coming is more substantial in the suburban markets. So all the capital chased the suburban markets where they believe that the consumer wanted to go. And so therefore you're going to have more supply coming in those suburban markets than in the urban market. So I think it's going to be a pressure across the board. But my view is the crime rates, the homeless, the office is not improving. I think that the office market, because of its not being back to pre-pandemic levels, coupled with the crime and homeless, is deterring what would be a reason to come back to the urban market as more likely than it would have been if it wasn't for those factors. I mean, look at the Bay Area, look at markets like LA, where the homeless is, or Austin, even New York, and not to the same extent. But there's some real problems in cities due to the homeless.
Okay, so some people I've talked to who live in the U.S. have been wondering whether or not they should put off on purchasing a home if they need to buy a home for a residence, for primary residence. So suppose you're currently renting right now. You're weighing in a couple of factors. One, the fact that we may be entering a recession, which may bring down home prices. But at the same time, if interest rates, the Fed funds rate, won't continue to rise much further than here, then we may see prices go up as rates stabilize. So we've got two competing forces here. How would you respond to this?
Right. Well, I think it depends on, one, again, you said if it's need based, but, I think the cost of ownership is not only being negatively affected because of higher rates, but you're also seeing substantial surges in insurance costs. So, for example, if you try to buy in the state of Florida right now, it might be 7 times what it was pre-pandemic to get property insurance, and I think homeowners insurance. And I think that those factors, sort of the hidden cost of home ownership, I think that people really need to be able to commit to a home need based and have cushion. So I think that today's environment is only going to get worse. And I also would say, I think there's a lot of complacency about these hidden costs. And people are coming to various locations that are only seeing those headwinds get worse. So I think you have to be very selective as to the rationale of why. And if you have support from family, help with the down payment, or there is someone that's actually buying the home for you. But, going in as a first-time buyer without the security of any type of cushion, I would be concerned right now in certain geographic markets more than others. But I think climate change and some of the regulations that are coming to fruition over the next few years is going to put pressure on those geographic markets that are most at risk.
And do you expect people to be, any first-time home purchasers right now, to be locking in rates at a fixed rate or perhaps getting them variable?
Right now, I would say they're probably more likely, locking in the best rate. So if that variable rate is more attractive because they think they'll refi, and that's really what we hear from most of our builders and our mortgage originators, is that people are expecting to refi as rates come back down.
Would it be possible to see variable rates actually higher than fixed rates right now because some people may be expecting rates to go down eventually?
It's possible. I mean, we definitely have seen some, interesting dynamics in the mortgage market because spreads have actually widened substantially because of the risk inherent in prepayments. A lot of the investors are not willing to take the risk as if rates come down. They will get obviously negatively impacted, assuming they have the servicing. So we're seeing very wide spreads and very not, risk off mentality. So you could see that come to fruition depending on what, investors' expectations are. And we'll see a lot probably over the next week or two with the FOMC meeting, as well as CPI. So that can really impact the overall pricing of mortgages. It's not just the 10-year. It has a lot to do with risk appetite and concerns about will there be distress? Will there be risk of prepayment? Those drive the spreads that have been at pretty much historic levels.
For the investor purchasing homes to rent out, how have cap rates today differed from, let's say, 5 years ago before the
Well,
rate increases?
Well, they've definitely expanded, and I think that we're going to continue to see pressure because of the, higher rate environment. So I think it's not as attractive today to purchase at today's cap rates, and I think that the values could be at risk because of the things that I've talked about, and whether it's the cost of ownership through insurance or the lack of ability to generate passive income on a continuous basis at the levels you underwrote. So I think it's going to be more challenging for those investors. And we're seeing it, for example, in the Palm Desert area. There's Airbnb units that could see overall income down anywhere from 20 to 50% right now. But yet their cost of capital is up substantially and their cost of maintaining that home is up substantially.
Right. So I'm currently based in Vancouver, where a large portion of the real estate market is based on investors from overseas. How much of this dynamic can be observed in the large cities in America, where we see investment potential and attractiveness being a bit major factor in prices?
Well, there's today, I think, just from the single family rental market where you tend to see more investors, there's call it something like approximately 35 million renters are single family renting out those units. And so, recognizing that that's really more a mom and pop industry. So it's individuals buying a handful of homes as opposed to the institutions, which probably in aggregate have about 2% of the market. So I think part of the challenge will be with if they try selling those homes within the environment they're in because they're having difficulty with getting their cash flows to work. Basically, they have a significant capital gain tax that they have to contemplate. So one of the things that I know that some people in the industry are trying to propose to Congress is to eliminate that overall capital gain tax for first-time homebuyers to create more inventory. But investors today could be really challenged because they're not going to get the returns that they may have thought. So I don't think it's a very attractive time to be buying right now because of those costs that I'm referring to and the higher cost of capital. In fact, if you look at the build for rent market, that market had exploded. And we estimate that there was a tremendous, call it $100 billion of capital raised. And now you're seeing acquisitions slow substantially just because they can't pencil the returns. Still there, capital wants to be deployed, but the costs have accelerated. So that doesn't pencil now.
That's interesting. I'm wondering whether or not the currency affects this at all. If I were to make the statement that a weaker U.S. dollar is better for home markets in certain areas because it's more attractive to foreign buyers, would you agree or disagree with that?
Well, I think, if the dollar is more appealing or more inexpensive, you may see investors using that arbitrage as an opportunity and would offset some of those higher costs. But it's tough to say. We haven't seen, we actually survey real estate brokers and we do that monthly. And we always ask them, have you seen an increased appetite from foreign buyers? And we really haven't seen any significant change. It's been pretty stable as of right now, but it's definitely possible.
Right. You brought up insurance costs. I'm curious as to why insurance costs have been going up.
Well, flooding, any types of storms, fires. I mean, State Farm has left the state of California. So there's a substantial change from the insurer's perspective on their willingness for that inherent risk associated with those geographies. And so the cost, if they're staying in the state or in that geography, they're increasing their cost dramatically. I just talked to an individual that owns a home in Naples, and they said that their insurance costs have gone up almost 10 times at a very high-end home that's at risk.
Okay. So, well, that's not really a factor people can control then. So is that going to be a permanent change, you think?
I think it will because there's only risk. Climate change is only going to get worse, not better. So I think that the insurers are well ahead of the general public, and the regulators are currently looking at systemic risk. If you look at FEMA, which currently is the regulator that oversees any flooding, they're really, not able to protect the mortgage originators and Fannie and Freddie. So FHFA is actually looking at trying to reduce the inherent risk, and it might need tighter underwriting standards to enable them to not have to have the type of prevalent risk that comes with these geographies that could be, seeing more headwinds than not.
Right.
I think
I've
affordability
seen.
is going to get squeezed because of that. I really do. And I don't think that it's on anyone's radar because it's not happening tomorrow. It's probably not happening in 24, but it's out there, and climate is continuing to create a lot of problems for regulators on what they're going to do about it.
What's that going to do for the consumer? I mean, most people can't just sell their homes because their insurance costs are going up, right?
It's just going to, think about the overall wallet. More non-discretionary will eat more into your overall income. So you have less discretionary. So it's just your choice. I'm not going out to dinner, as much, or I'm not going to go on vacation, but you have to pay your utilities. You have to pay your homeowner's insurance. You have to pay your mortgage. So, people have to make priorities and make decisions of what's important to them. But I do think that those costs are going to continue to rise. So if they're locked in at a low rate and they have a good job and their income is stable, they should expect to see their discretionary income shrink as they have to allocate more to non-discretionary.
So you think it's going to weigh in on the discretionary income, but it's not going to be as bad to the point where you're going to see higher foreclosure rates and delinquency rates on mortgages.
I mean, it's possible if the economy were to slow into a more substantial recession, of course. People are losing their jobs and they can't make their mortgage payment, irrespective of anything else. There's always defaults. And we've always seen distress. The order of magnitude is dependent upon how severe the economic downturn is. Right now, we're not expecting the housing market to have a severe downturn. In fact, we jokingly say the residential market could be, or is a tall midget in an environment where you would have a softening economy.
Recently, I've seen some stats of Airbnb prices dropping, especially in the Sunbelt cities, for a whole host of reasons. Is this indicative of anything?
Just addressing, as I mentioned, the Palm Desert is seeing that. So I think you're seeing markets where people were fleeing the cities they were living in for more space and more distance, and therefore they're not needing that anymore because they're coming back to work. So you don't see the same amount of demand for short-term rentals, and therefore the Airbnb market is feeling pressure. And that's why I said if you're looking at areas that could show some distress, I think that is where there might be some forced selling because those people just can't carry those costs anymore, and those costs are going up. But the market is not changed. If you look at, the IRS and tax dollars that come from overall number of investors, it really hasn't increased over the last 10 years. Because you can measure it by IRS data. And in fact, what's happened is just more has been allocated to Airbnb. So it's a market share gain, but they're definitely seeing pressure overall in the amount of income they're generating, which could lead to pressure on their ability to carry and therefore sell. But the market is still not as significant as people perceive in that Airbnb. Maybe I think it's 10% of the market or something, but it's not immaterial either.
If you were an investor looking to buy a second or third home as an investment, what are the criteria you should be checking off if you had the ability to pick any jurisdiction in the country?
What's your time horizon? You talking about a
Uh,
year, 10 years?
well, I'd say I would buy and hold, so maybe 10 years.
I would probably look for more areas that will have less impact from higher insurance costs and other hitting costs. So, for example, there is a chip plant being built in Columbus, Ohio right now that's going to generate millions of jobs. I don't know, millions, but, significant amount of incremental jobs. And that market is low cost and relative low risk from a climate change and therefore less insurance risk. So I don't know. I think about the smile states are more at risk, and more central Midwest markets will be the beneficiary of not having more affordable choices, as well as less likely that insurance costs are going to rise and less storm slash flooding damage, hurricanes, maybe some tornadoes.
Yeah, tornadoes are terrible. Avoid tornadoes. Generally speaking, looking long term, people are getting married later, having children a bit later in their lives, and household formation may, some speculate long term in the future, may decline. Would this have any significant impact on not just the types of homes being purchased, but also home builders' priorities?
Well, I think the demographics very much suggest that we're going to see household growth slow. We're forecasting it to nearly the next decade will go from, call it 7-8% down to 4% household growth. And that's really a function of population growth. And population growth is a function of immigration, death, and birth rates. And we know immigration's under pressure. Death rates have accelerated even without COVID. So it only has made it worse. And birth rates have been under pressure. So all of that results in less population growth, which therefore less household growth. And we're also seeing multi-generational living because of the affordability challenges. So I think it is going to affect home builders. But right now, the level of growth they're getting from market share gains and continued wealth effects, again, wealth transfer, people feeling the relocation benefits of people leaving one high cost state to the other, it's still been more favorable than you would expect. But I think the demographics bode very negatively longer term right now.
Okay. Finally, can we learn a little bit more about Zelman Associates, the type of work that you do? And I believe you have an annual housing summit coming up. So what can we learn from this?
Well, thank you for having me, David. I appreciate it, and great luck.
Yeah,
Good
for
luck with
sure.
your show. Zelman Associates is really a research specialized firm or a research firm that specializes in housing. And what we are really based on is doing foundational thematic work and understanding where we are in the cycle. And we overlay that foundational view with surveys that we do monthly. And we're surveying all aspects of housing. So whether it be home building, new construction, existing homes, the mortgage industry, the resale market, multifamily, single family rental, as well as building products, home improvement. We also analyze stocks that are in that ecosystem. So we are looking at stocks relative to one another and who's the outperformers, who's the underperformers, basically which stocks you should buy, which you should sell. And in addition to that, we also do investment banking. So we host an annual summit, which we do in September. Well, this year will actually be our last virtual one, thank goodness. But if anyone's interested, they can contact Kim at ZelmanAssociates.com, and she can provide all the insight. But I think it's a really great conference. We'll have a climate panel. We have panels from C-suite executives across all aspects of housing. So there's a realtor panel, there's a new home builder panel, there's a building products panel, and we have executives, which my colleagues and I moderate discussions. So it's about 2 days, and broken up with institutional investors meeting with C-suite executives. So it's a pretty unique format. And we also provide a state of the nation on the outlook for housing to our viewers.
All right, we'll put a link in the description down below. Before we go, can you actually just give us one interesting fact or factoid that you've discovered through your research this year? You do some amazing research, so I'm curious to learn what you've learned that maybe surprised you.
I've been really surprised by the resilience of the overall market. And I think it goes back to, I think about back 30 years ago when I was building regression models and realizing that it's really about jobs and jobs and jobs and consumers' confidence in those jobs. So no matter what affordability is doing, as long as people are feeling good about their situations, the resilience has been, it reminds me back to the early days when we were doing that, as opposed to being concerned with every 10 basis point increase in rates. So the rates are secondary to confidence in jobs. So I knew that, but watching the 10-year backup, I would have thought housing would have been more negatively impacted in the most recent months if we've seen rates go back to 7%. And I'm quite surprised by that. But I don't know that any more than that. I'm really focused on climate change right now. I'm really hot to trot on it. I've got some really interesting academics that will join us for our housing summit. And I'm trying to speak with regulators. I think there's a lot of, unfortunately, risk longer term, and I want to uncover that. So I'm going to be focused there.
Well, one thing we haven't talked about, maybe we can save for another conversation another time, is rising sea levels, whether or not that's going to have a big impact on the shore cities.
Yeah, I mean, that's the work we're doing. I don't have enough knowledge yet, David, but I'm digging, and I'm like a dog with a bone. I'm going after this one because I think there's something to be concerned about, and I want to understand it better.
All right. Well, we can stay tuned to your work and visit your
Thank you for having
housing
me.
summit. Thank you very much for being on the show
Appreciate
today.
it. Good
Thank you.
luck.
Appreciate it. Right. And thank you for watching. Don't forget to subscribe.